Here's a crazy fact: U.S. savings rates hit an all-time low of just 3% in 2023. That's one of the lowest levels in decades. But here's the kicker: the stock market? It's been hitting record highs. You'd think with so little money saved, stock prices would be tanking, right? Wrong. In fact, between 2020 and 2022, the S&P 500 soared by over 50%, despite many households living paycheck to paycheck. It doesn't make sense at first glance. How can stocks rise when no one's saving? That's exactly what we'll dig into. There are hidden forces keeping the market alive and kicking. From companies using their own money to buy back stock to central banks flooding the economy with cash, there's a lot going on behind the scenes. In this video, we'll break it all down: why spending keeps the economy afloat, how corporate stock buybacks create artificial boosts, and how big investors control most of the market. Stick around, and by the end, you'll understand why stocks keep rising even when the average person's savings are shrinking. Chapter 1. The Paradox of Spending. Why money still moves markets. It's strange, isn't it? If people aren't saving money, how is the stock market still climbing? Well, here's the deal: consumer spending is still a massive driver of economic growth. Even though savings rates have dropped, spending hasn't stopped. In fact, people are spending more, often by borrowing. Did you know that U.S. household debt hit over $16 trillion in 2022? That's a record high. Credit cards, mortgages, auto loans, people are still finding ways to spend, and that spending keeps the economy and stock market moving. It may sound counterintuitive, but when people spend instead of saving, companies keep growing. And where does this spending money come from? Government stimulus checks, for one. During the pandemic, a lot of households received financial support, and instead of saving it, they spent it. This created a temporary demand surge for goods and services, driving company revenues up and keeping stock prices high. In his book The Intelligent Investor, Benjamin Graham emphasized that markets are driven by emotions as much as fundamentals. This can explain why, even when savings are low, the market remains strong, because people believe in future growth. Consumer confidence also plays a big role here. When people feel optimistic, they tend to spend more, even if it means going into debt. But the big question is, how long can this last? If no one saves, there's less cushion for economic downturns. Yet for now, companies are riding the wave of consumer demand, and that's enough to keep stock prices up. Chapter 2. Corporate cash cows. The secret of stock buybacks. Let's talk about one of the most powerful forces behind rising stock prices: stock buybacks. Big corporations like Apple and Microsoft spend billions buying back their own shares. In 2021 alone, U.S. companies repurchased nearly $900 billion worth of their own stocks. Why do they do this? It's a way to boost their share prices without needing more sales or revenue. Buybacks reduce the number of shares in circulation, which makes each remaining share more valuable. Imagine a pizza being cut into fewer slices. It doesn't get bigger, but each slice represents a larger piece of the whole. But here's the twist: many of these buybacks are funded through corporate debt. Companies are borrowing money at low interest rates and using it to buy back shares. This creates an artificial boost in stock prices without any real improvement in the company's financial health. The Harvard Business Review calls it short-termism, where companies prioritize immediate gains over long-term growth. It's a strategy that can keep stock prices rising even when consumers aren't saving or investing more. It's also why value investors need to be cautious. Just because a company's stock price is going up doesn't mean its actual value is increasing. Warren Buffett has often warned about companies focusing too much on buybacks. He believes in reinvesting profits into growing the business, not just inflating stock prices. But for now, buybacks are a key reason why the market keeps climbing, even in an environment of low savings. Chapter 3. The Hidden Hand. Institutional investors and their relentless buying power. If you're wondering who's really driving stock prices up, look no further than institutional investors. We're talking about hedge funds, pension funds, and sovereign wealth funds. These big players control vast amounts of capital, and they're constantly buying into the market. As of 2023, institutional investors owned about 80% of all U.S. stocks. That's right, most of the market isn't even owned by everyday people. These institutional players have deep pockets, and they aren't as worried about short-term fluctuations. They're in it for the long haul, which means they keep buying, even when retail investors are pulling back or saving less. What's interesting is that these investors often don't care if consumers aren't saving. They focus on corporate earnings, sector trends, and long-term growth. Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds, once said, "He who lives by the crystal ball is bound to eat ground glass." What he meant is that market timing doesn't matter as much as strong fundamentals. These big investors believe that over time, the market will keep growing. And here's another thing: institutional investors often use algorithmic trading. This means they're using advanced computer programs to buy and sell stocks at lightning speed. These algorithms aren't driven by emotions or market news like regular investors. They follow patterns and data, which can keep stock prices moving up even when there's panic in the broader market. All of this creates a constant demand for stocks, helping prices rise even when it seems like regular people aren't saving or investing as much. So, while it may seem odd that the market is climbing when savings are low, these behind-the-scenes forces are pushing prices higher. If you're finding this information helpful, don't forget to subscribe. You won't want to miss the upcoming chapters that will reveal more about how the stock market keeps rising against all odds. Chapter 4. Cheap debt, expensive stocks. The low-interest illusion. Low interest rates have quietly reshaped the investing world. Over the last decade, central banks have kept interest rates near historic lows. But what does this have to do with rising stock prices? A lot, actually. When borrowing is cheap, companies can easily take on debt to grow their business or, as we talked about earlier, buy back their own stock. Let's break it down. With interest rates hovering close to zero, companies are borrowing more because it costs less. In 2023, U.S. corporate debt exceeded $11 trillion. But instead of using that money to improve their operations, many are using it to boost their stock price. It's a temporary fix that makes the company look better than it is. Low rates don't just help companies, though. They also push individual investors into stocks. With bond yields so low, there aren't many attractive alternatives to earn a decent return. If bonds are offering 1–2%, but stocks promise 7–10%, it's no surprise that more people flock to equities. As a result, demand for stocks goes up, and prices rise. But there's a catch. Low interest rates make the market look healthier than it really is. Investors are often lured into overpaying for stocks, driving up valuations. In 2021, the S&P 500's price-to-earnings ratio hit 35, far above its historical average of 16. This means that stocks are getting more expensive relative to their earnings. Howard Marks, a well-known investor and co-founder of Oaktree Capital, said, "Low interest rates are like a powerful drug. They can create a feeling of invincibility. And that's the risk here. When rates eventually rise, companies that relied on cheap debt could find themselves in trouble." For now, though, low rates continue to inflate stock prices, even when personal savings are down. Chapter 5. Tech titans and bubble machines. Growth at any cost. Technology companies have become the giants of the stock market. Think of companies like Amazon, Apple, and Tesla. They've grown at a pace that would make traditional value investors scratch their heads. But here's the thing. Many of these tech giants aren't valued for their current profits. They're valued for their future potential. This is where growth investing comes into play. Unlike value investing, which focuses on buying undervalued stocks, growth investing is about betting on companies that will dominate in the future, even if they aren't making huge profits today. Tesla is a great example. For years, the company barely turned a profit, but its stock price soared because investors believed it would revolutionize the electric vehicle market. In 2020, Tesla's market cap exceeded $800 billion, making it more valuable than all other car companies combined. Yet, traditional investors like Charlie Munger were skeptical. He once said, "I think there are a lot of troubles coming. There's too much wretched excess." Munger's point was that stock prices had become disconnected from actual business performance. Many of these tech companies also benefit from network effects. The more people use their platforms, the more valuable they become. This creates a winner-takes-all scenario where one or two companies dominate their sectors, even if they aren't making money yet. But this strategy comes with risk. When investors are betting on future growth, any sign of trouble can cause a sharp drop in stock prices. This is why growth stocks are often more volatile than value stocks. Still, for now, tech companies are a major reason why the stock market keeps rising, even if people aren't saving or investing much. If you enjoyed this video and want to stay updated on future content, make sure to subscribe. Understanding these market forces is crucial for anyone looking to navigate today's investing landscape.